Good afternoon. It's Thursday, April 9th. I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our special weekly market update. We're recording on Thursday in advance of the Good Friday Easter weekend holiday. The week that was, starting on April 4th through today, saw a number of different news items, a little bit quieter maybe than some previous weeks. That might be welcome for many of us. The number of diagnosed cases and deaths associated with the coronavirus continued to rise in the U.S., although there were some good signs about some of those numbers starting to trend in the right direction. Confirmed cases in the U.S. by early in the week were already twice that of any other nation, and U.S. cases exceeded 400,000 by the end of April 8th. However, stock markets around the world were sharply higher through Thursday morning as hope continued to rise that the virus curves were flattening in response to social distancing measures and some of the therapeutics that were coming around, like Gilead's remdesivir and something called convalescent plasma. They're both showing promise. The Bill and Melinda Gates Foundation, among many others, have begun investing billions of dollars in search of effective therapies and vaccine for the coronavirus. The CARES Act really came into full view this week. That's the large government stimulus bill, over $2 trillion of economic support for small businesses, workers, hospitals, and states. There were some initial adjustments to the CARES Act, as could be expected. Something that big put together that fast. There were some hiccups there, and so regulatory rules were being formed. But it's hoped that a lot of that money will begin to get to the intended recipients here in the next week or two. Just this morning, new jobless claims continued to rise with another 6.6 million in filings. That brings the jobless number to a record high somewhere north of 13 million people. But again, a lot of those filings, I think, are due to what we see in the CARES Act, where people are being encouraged actively to apply for benefits as soon as they can so that their circumstances can be stabilized and the economy as a whole can do as well as possible going forward. The week in markets saw U.S. and foreign stock markets, as I mentioned, they started out the week with very strong gains between 5 and 9% on Monday, depending on which part of the world you were looking at. Wednesday and Thursday through midday saw significant gains as well. Signs of improvement again regarding combating the virus around the world has just rekindled feelings of optimism that perhaps the worst of the health crisis will soon be behind us and people will go back to more of a normal life and economic activity will begin to improve and speed up. We'll see things happening in the public spaces. Stock market really has been a traditionally leading indicator of economic activity. So when we see stock markets rise like they have, what's happening there is investors largely are seeing signs of optimism and they're responding to that by actually beginning to buy stocks again. You're seeing prices rise as a result of that. This often happens before there's any measure released anyway of economic activity. In this case, what's really interesting is we have very few measures of economic activity showing negative signs. Those are probably going to come out this quarter as we see the impact of what happened in the first quarter and through the second quarter. But because of the speed that things are happening, not only have we not seen negative economic data, we haven't seen any positive economic data, yet the market has already declined and begun to recover before we see any really hard data from the normal economic providers. For the entire year, broad measures of the stock market are down in the U.S. around 15% midday today on Thursday. Foreign stocks are down around 20%. Small companies have seen greater declines than large companies, and foreign stocks are slightly lagging the U.S. stock market. Both relationships are continuations of how markets performed in 2019. Bond markets continue to be relatively stable as the Fed remains at the ready to provide liquidity as needed. So when you look at the picture here year to date, it looks about what you'd expect in pressure on the stock market. Stocks have gone down significantly. They've begun to recover. And during that recovery period, bonds have continued to provide some positive return and stability for investors with diversified portfolios. The S&P officially entered a new bull market actually on Tuesday. It closed Wednesday up over 22% from the most recent low point on March 23rd. The index rose from the recent trough to official bull market territory in 15 days. The 49 days from the February 19th peak to March 23rd trough to Wednesday's close makes this one of the shortest bear markets in history. It's kind of been incredible in terms of the velocity that we've seen change occur here in the first 3.5 months of the year. With all that change in the stock market, one of the things that happens is people begin to look for news about what they should be doing with their portfolio. And Just yesterday in the Wall Street Journal, there was an article by Professor Burton Malkiel called "It's a Good Time to Stock Up." Some people might recognize Professor Malkiel's name. He wrote a book called A Random Walk Down Wall Street. It's a very famous book about stock market investing. And then also later in the day on Bloomberg's news site, you see S&P 500 rallies to fresh bull market territory. Oil rises, markets wrap. What's happening here is there's a lot of positive news out there regarding market performance, and we've begun to have people ask, hey, is this a time to increase their stock market exposure? It's interesting, isn't it? We've gone through a period of significant decline, really hard times, and yet now coming out as we see stock markets start to rise, the appetite maybe for taking on additional risk by buying additional stocks in the portfolio seems to be cropping up in people's minds. So with that in mind, I thought we'd just talk about how and when to add stocks to your portfolio if you're thinking about that. There's maybe some good ways to do it and not so good ways. So what we're listing here are 3 ways to think about how and when to add stocks to your portfolio. The first one on the list is rebalancing the portfolio. We talked about this a couple weeks ago, and basically what we're doing here is we're rebalancing the portfolio from bonds to stocks. So while stocks have declined, bonds have held their own or possibly increased. If your original kind of intended balance in your portfolio is 60% in stocks and 40% in bonds, it's likely that you own less than 60% in stocks today and more than that and more than 40% in bonds. And so rebalancing is simply taking some of that overweight in bonds. Let's say you're at 45 and stocks are at 55, and you're just selling the bonds and buying the stocks. You're not adding any new money to the portfolio. You're just rebalancing it back to your policy allocation. And what happens there is you keep your risk or volatility in the portfolio equal to what you originally intended, that 60-40 mix. Your expected return in the portfolio should stay about the same as well, because again, we're targeting the original 60-40 mix. So both the percentage return and the dollar return of that portfolio should be about the same. You are reducing your portfolio liquidity a little bit because you're selling some bonds and you're buying some stocks. Those bonds are generally more liquid. They hold their value. They're a more stable asset than the stock side. So one way simply to add stocks to your portfolio is the discipline of rebalancing. A second way to add stocks to your portfolio would just be through the infusion of new money. If you've had cash or continue to receive income that you don't need for living expenses, you may look at that new cash and say, well, I'm going to put that in my portfolio. What happens is you add new money to a portfolio in conditions like this, again, kind of like rebalancing. If you were intending the portfolio to be 60% in stocks and 40% in bonds, what's happening is you're buying stocks with the new money. You're also buying bonds with the new money. But if the portfolio is out of balance, let's see, it only owns 55% in stocks. What happens there is the majority of your cash, new cash going into the portfolio, is buying stocks. So you're actually adding stocks to the portfolio. You're buying them at a lower cost, but you're doing it with new cash flows. Again, the risk or volatility in your overall portfolio stays about the same because you're buying back to that 60-40 allocation. The expected return on the portfolio in terms of percentage wise stays about the same because again, you're targeting your same risk return allocation, but the dollar return actually has increased. You've added dollars to the portfolio and you've added them to the stock side of the portfolio. So the expected return long term in terms of just the dollars that you have invested, those dollars should grow more. You have more dollars at work. If the expected return is higher, that would yield more dollars in long-term investment return. Portfolio liquidity is actually increased or maybe stayed the same in dollar terms. Again, if you're adding new money, you could be buying both stocks and bonds. If you're buying both, the liquidity in the portfolio in terms of that dollar measure is increasing. The third one, though, is one we have to be careful of, and this is people who are considering changing the allocation in their portfolio to hold a higher target percentage of stocks and then rebalancing to that new allocation. So imagine, again, you're that 60-40 investment portfolio, and instead you say, I'd like to own more stocks than I do now. So I want to change my portfolio allocation from 60-40 to 70-30, so 70% in stocks. So what's happening there is you're actually increasing the potential risk or volatility of your portfolio because now it's a more stock-heavy portfolio, right? You're likely also increasing your expected return over a long period of time. But again, that's an expected return. There's no guarantee that that return will be accomplished in any short period of time, especially. But the percentage expected return and the dollar return over time is rising as you become more aggressive in the way that you hold that investment portfolio. The portfolio liquidity, though, is actually declining. If you think about what's happening there, if you're changing your portfolio allocation from 60-40, 40% in bonds, to 70-30, just 30, all of a sudden you have a 10% reduction in liquidity. And if you're doing this at a time when you're already out of balance, let's say instead of 60-40, you were sitting at 55-45, going all the way to 70-30, you've kind of done a double blow really to your liquidity in the portfolio. I would suggest that if you're thinking about a change in the portfolio, the first principle to a better outcome from Foster Group's perspective is always to remember that planning drives or informs your portfolio construction and your allocation in every environment. If the 60-40 portfolio that you had going into this crisis was the appropriate allocation, in other words, it was the right balance of risk and return, it was meant to provide enough return to meet your financial goals long term, it was also there to provide enough liquidity for the cash flows that you need in the next few years, it's likely that portfolio allocation is still the right one based on your planning work. So you want to be careful about seeing headlines that say, hey, now's the time to get back into stocks, and then actually adding more stocks as an allocation percentage to your portfolio. That really stacks the risk of the portfolio up, makes it much a higher risk portfolio potentially, and it also reduces your liquidity. Both things could work against all the planning work that you had done going into this crisis. It's great that we're seeing signs of life in equity markets, but you want to be careful that you don't let kind of that good mood or that sentiment that's kind of coming into markets right now cause you to take actions that really aren't based on your plan. As we've been talking about adding stocks to the portfolio, one of the questions that comes up sometimes is, why do we hold bonds in the portfolio at all? That seems like kind of a funny question given all the stock volatility we've seen here in the last few weeks. But the question really gets at to what's the benefit of a diversification strategy using both stocks and bonds? We had a question from a client saying, shouldn't really an investor always hold some bonds in the portfolio, even if it's just to have some, quote, dry powder when equity markets go down like they have recently? So we thought we'd just look at that with a series of slides where we're going to compare the Russell 3000 index, which is a collection of the largest 3,000 publicly traded companies in the United States, versus the Bloomberg Barclays U.S. Aggregate Bond Index, which is all the investment grade bonds issued in the U.S., and then a portfolio or a combination allocation of the Russell 3000, representing 90% of the portfolio allocation, and 10% in the aggregate bond index, to see what we can learn from looking at that diversified portfolio. Though it's not that diversified, but at least there is some bonds in the portfolio, by looking at that over different time periods. If we go back to 1979, which is when the Russell Index was incepted, so this is the longest period that we have data for that 3,000 stock index, we can see that over that period of time, a 100% stock portfolio would have won in terms of absolute return. If we look at times of pressure in the stock market, though, we can see why people want to have some bonds in their portfolio when stocks are going down, because bonds tend to be somewhat negatively correlated to stocks. They tend to go up when stocks are going down. We look at the dot-com bubble in the early 2000s, you can see that exact thing happening. The bond market, represented by the Barclays Aggregate Bond Index, is trending upward there, the blue line, while the stock portfolio and the blended portfolio is kind of following that stock market down and then recovering. Same thing happening in the great financial crisis in 2007 to 2014, when stock markets were going down and then that extreme pressure into the bear market and recession. Bonds tended to trend upward, and they just kept doing that even as stocks went down and then ultimately recovered. If we look at kind of that entire period from 2000 to 2019, what we see there is, again, kind of the volatility of stocks, both in the 100% stock portfolio represented by the Russell 3000, but also that 90-10 mix. If you look at the kind of the blue, the dark blue, and the green line, what you notice is they look a lot the same. They track each other very closely. That's because most of the portfolio risk is driven by that Russell 3000 stock index. It's 90% of the portfolio, only 10% in bonds. So those few bonds don't influence really what's going on at the portfolio level, because there's just not very many of them. The thing I like about this picture is you see that at the end of the period, both the Russell 3000 as an all stock investment or the blended portfolio give the investor just about the same return. Again, if I extend this even to March of 2020, so the period we just kind of ended, what you can see is here, just with that new little piece of pressure in the market over the kind of the end of February and into March, all of a sudden that 90% stock, 10% bond portfolio is now ahead of the all equity portfolio. You can see the volatility associated with having just stocks in the portfolio. So the question about whether or not to have some bonds in the portfolio is really a good one. And from our point of view, most of the time, a diversified portfolio absolutely makes sense. Sure, the long-term winner in this kind of picture, we expect to be stocks. And really, if you go back to 1979, even if you include the returns through March of 2020, long-term stocks were the absolute winner. But a couple of things to keep in mind here. A small amount of bonds doesn't necessarily keep the portfolio from experiencing stock-like risk and volatility, but that small amount of bonds in a regular rebalanced portfolio doesn't detract that much from the long-term return. The other thing I'd note is it's nice to be able to look at your portfolio and see something that's always doing well. An investor that has 100% in stocks, sometimes, like the last few weeks, they're going to look at that portfolio and everything's going to be going down. An investor who has a diversified portfolio is going to be able to look at that portfolio and find that bonds or cash element, and they're going to say, well, at least that part of my portfolio is continuing to do well. And that can have really positive behavioral impacts in terms of keeping us invested in the portfolio that makes sense for us in light of our financial plan. So why hold bonds at all? Well, the return over the long period of time, again, not that different. The stock market portfolio represented by the Russell 3000 was up 11.2% in that period versus the 90-10 portfolio up about 10.95, both significantly outperforming bonds, which came in at 7.4% since 1979. Having that diversified portfolio does moderate the lows and the highs. It moderates annual volatility. And again, as I mentioned, the key here is you almost always have something in your portfolio that's doing relatively well. And this can be a tremendous benefit behaviorally. The principle here, really, when we look at this, is this: unless absolute return is your only goal, in other words, the only goal over some very long period of time is to get the absolute highest return you can, and there's no compensation for risk in your equation. Other than that, some diversification other than equities or market risk is generally a good idea for an investor. And depending on the time period, that little level of diversification doesn't need to be too costly. As we close up today, I've got my quote of the week. This one has to do with that very diversification principle. This is from a book by Peter Bernstein, who's written a book called Against the Gods, The Remarkable Story of Risk, where he just talks about mankind's attempt to manage risk over history. And he says this about diversification. He says, diversification is not a guarantee against loss, only against losing everything all at once. Sometimes that feeling of having everything going down all at the same time is just too painful. Having a diversified portfolio allows you to find at least some bright lights in the portfolio, even when the stock market looks to be so negative. Thanks for joining us this week, and we hope to see you next week.